And today is Tuesday, April the 8th, 4:30 p.m. Pacific time. And this is part 3 of the 100K portfolio series. And I'm going to start this video by spending a few minutes talking about the box spread. Now, remember that half of the 100K is in a box spread. And the reason I have it set up that way is because rather than having 50K sitting idly in cash, I wanted to earn a little something. So you can buy treasury bills, you can buy a 1-year CD, for example, a 6-month CD, and then renew it if you think rates are going to go higher in 6 months, so forth and so on. But at the time, when I established this box spread, and by the way, this was transferred over from another account because when I started or I decided to do this video series, I did mention that I was going to use half of the money in a box spread. So this is what I'm using for that half. Anyway, what I want to mention is quickly how the construction of the box spread works. So let me demonstrate by setting one up. You're going to buy an SPX box, and you're going to go out about a year in time. So note here that the March 31st, 2026 expiration is 357 days away. Not quite a year, but effectively a year, close enough for our purposes. So I'll use this. And today's close in SPX was 49.82. Wild day, by the way. Wild day. Honestly, I haven't seen markets with this kind of volatility ever, and I've seen some crazy markets. The soybean market in 1996, for example. When LTCM blew out in 98, I believe. The 2000 presidential election, since that was up in the air for roughly a month, that was absolutely insane. 9/11 in 2001. And the summer of 2002, there were, I think it was that summer, some accounting scandals that drove the markets to very high levels of volatility. But anyway, let's go through construction of a box spread in which we want to have 50,000 at expiration. So what we're going to do is we're going to use, notice here that cash closed, again, around 49.82. So I'll just work with the area around 5,000. So we're going to go 250 below to the 47.50 strike. We're going to go 250 above to the 52.50 strike. So that's going to take care of the call side. Now note this is a bullish call spread. It's a vertical spread. And the width between the 47.50 strike and the 52.50 strike is 500. Now let's do the put side. We're going to buy the 52.50 put, and we're going to sell the 47.50 put. And again, this is a box spread that's 500 wide. So at expiration, this spread is going to be worth $50,000. Now, we have to pay for it up front. And the cost, let's make it a little simpler. Let's go up to 481. So let's say that this spread cost us 481 times the multiplier for the SPU of 100. That's going to cost us $48,100. And what we will receive in profit at expiration is going to be $1,900. So the implied interest rate on this is going to simply be the 1,900 divided by our outlay, 48,100. And the implied rate we're getting is roughly 3.95%. So by doing this trade, we're going to earn almost 4% on our money without having to bother going to hunt down a CD from a bank or any other such money market instrument that you're going to use to hold your cash and receive interest over the course of a year. So again, this is going to cost us $48,100. And remember, since this box spread is going to go out, no matter where the market closes, at a value of 500, it's going to be worth $50,000. If you think about it real quick, let's say that a year or at expiration, which is March 31st of 2026, SPX closes at 4,700. Well, the call spread that you bought is worthless, but this put spread is going to go out for full value, and that's going to be worth 50,000. If the market closes on the upside and outside of the box, let's say 5,300, well, this put spread is worthless, but the call spread is going to be worth full value, and that's going to be $50,000. What if it closes in between the box? Well, let's say it closes exactly in the middle at 5,000. Well, the call spread is going to be worth half value because this 5,000 strike is exactly in the middle of the 47.50 strike and the 52.50 strike. So the call spread is going to be worth 25,000, and the corresponding put spread here is also going to be worth 25,000 because it's going to close right in the middle. So wherever the market closes, this box spread is going to go out at $50,000, and as I mentioned, we're going to get $1,900 in profit. So the implied interest rate is 3.95%. Was that right? 3.95%. Okay, so that covers the box spread. So we know that no matter what happens, we're going to get that $1,900, and out of the 100K portfolio, that's going to be just 1.9%. So you're getting this 1.9% regardless of what happens in the rest of the portfolio. So now let's take a brief look at some of the stocks that I have. Well, actually, the stocks that I currently have in the portfolio. And note here I have SIBO, that's the options exchange in Chicago, DraftKings, Intel, Kraft Heinz, Mondelez, Moderna, NU, and I have something very interesting going on in Palantir, which I'm going to talk about in a separate video. I use the SPY. He doesn't like the Amazon truck guy. I use the SPY to begin to hedge the portfolio. Today, let me spend a few minutes talking about today because that was pretty interesting. Earlier today, and my timing was fortunate, we had a huge rally in the market, and let me show you where SPY was early in the morning. I want to say just under 525 maybe was the high. It's coming up. So today's high was at 7 a.m. and almost 525, 524.98. And then we had a huge move the rest of the day. And these moves are just the magnitude of these moves and the frequency with which this is happening is unprecedented. I honestly believe that there's not a trader alive, regardless of years of experience, who's seen this kind of volatility. It's unprecedented. But anyway, note that the low of the day ended up being 486.20. So almost 40 handles, in the SPY, which is just huge. This is just an unprecedented move. I think the emini contract, it was somewhere around 300 from high to low, which is insane. But anyway. Okay, so due to the length of the video running a bit longer than I would have liked, I decided to do a little slice and dice, and I'm going to divide this third video into two parts. So it's going to become part 3 and part 4. That way, I just wanted to be respectful of people's time constraints, and I don't want the video going much longer than 10 minutes, and it ran almost twice as long as that. So as I mentioned, I'm going to divide it into 2. All right. Thank you for tuning in. Part 4 will be delivered shortly after part 3 arrives. Thank you for watching, and I'll catch you guys next time.